According to the Global Industry Classification Standard, there are 11 stock market sectors. They are materials, industrials, financials, technology, consumer discretionary, consumer staples, energy, healthcare, communication services, utilities, and real estate. These sectors are usually broken out into 2 or 3 parent groups based on how they tend to behave under different economic circumstances. Those groups are cyclical, defensive, and sensitive. Cyclical and defensive are always used, but not everybody includes the sensitive group. Cyclical sectors are those that tend to be comparatively more affected by the strength of the economy. They tend to perform really well when the economy is strong, or at least gaining in strength, but struggle to protect capital when the economy is weak or weakening. The sectors that are traditionally considered cyclical are materials, industrials, financials, tech, and consumer discretionary. And depending on who you ask, real estate is also sometimes thrown in. Defensive sectors are on the opposite end of the spectrum. The companies that make up this group usually are in the business of providing products and services that are in demand regardless of how the economy is doing. This tends to lead to them performing better than cyclicals during economic downturns, but not having quite as high of a return ceiling when the economy is gaining momentum. The sectors that are traditionally considered defensive are consumer staples, energy, healthcare, communication services, utilities, and, depending on who you ask, real estate. Sensitive sectors are an in-between gray area. Some sectors have a fair amount of companies that sell both luxuries and necessities, so their revenues are definitely noticeably affected by the changing economic conditions, but not nearly as much as traditionally cyclical sectors. There is a bit of overlap with the cyclical and defensive sectors here because not everybody uses the sensitive group in their analysis, as I said, but the sectors that are sometimes considered sensitive are industrials, tech, energy, communication services, and real estate. So real estate can actually fall in any of the 3 categories depending on the specific makeup of the fund and who's doing the analysis. As we'll see today, these trends are not universally true for every sector in every time period, but it is the general trend we expect to see most of the time. With that being said, let's get into the individual sectors, discuss what they do, and how they've performed historically as investments. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. To gather data on historical investment performance, I'll be using the index funds that you see on your screen now. With the exception of the communications services and real estate sectors, which have full year data going back to around 2001 or 2002, all the data will be going back to the start of 2000. Since we don't have a ton of data to work with, we'll be measuring things like long-term returns by the 5-year rolling inflation-adjusted returns, as opposed to 10 or 40-year windows like I usually do. The materials sector contains companies that produce, distribute, and sell raw materials like plastic or lumber, which are used by other companies to make products that we later buy. Think of them as the building blocks of the market, getting the ball rolling for companies in a bunch of other sectors. Companies in this sector usually fall into either the chemical, construction material, container and packaging, metals and mining, or paper and forest product industries. Some of the most well-known companies in this sector include International Paper, Ecolab, and PPG Industries. And since most material sector companies' revenues are tied closely with the price of commodities, which, as we've experienced in 2020 and 2021, tend to fluctuate quite a bit, they are usually considered to be cyclical investments. In terms of investment performance, the thing that really jumps out about the materials sector, compared to all the others, is its dependability and its ability to rebound well from market bottoms. It had the best start date sensitivity figures and the second highest comeback magnitude of any sector. This makes sense given how early in the supply chain the companies in this sector usually fall in. When things are picking up, they're usually among the first beneficiaries, and vice versa. So despite its above average short-term volatility, it tends to stabilize well over the longer term. On your screen now, you can see where this sector ranked among a variety of metrics. You may notice as we move forward that some of these sectors have identical rankings in some metrics. That's because of ties. If 2 sectors were tied for third best in a metric, I just gave them both the third best rank. The industrials sector covers quite a wide variety of industries such as aerospace and defense, construction and engineering, machinery and electrical equipment, industrial conglomerates, trading companies, commercial and professional services and suppliers, transportation and infrastructure, airlines, and many more. The average person generally doesn't buy much from these companies. Instead, these companies provide products and services, as opposed to raw materials, to other businesses who then sell to people like you and me. An example of this would be Boeing, who produces airplanes for the airline that sell you and me tickets for our vacations. Similar to the materials sector, the industrial sector is usually considered cyclical, as it is dependent on the strength of the economy, though Morningstar classifies it as sensitive, suggesting that they don't see quite as much dependence on the economy as the materials sector. When things are going well and consumers are buying more products and services from businesses, there's more demand for business-to-business products and services that the industrial sector tends to provide. When things aren't going so well, demand falls. As an investment, industrials don't really jump out in any particular metric. It's hovered at or a little above the middle of the pack in terms of returns and volatility, at least since 2000. However, as a result of this middling performance, it also doesn't really struggle as much in any given metric as many of the other sectors do, ranking no lower than 8th in any metric that I measured. So relative to this field, industrials has been pretty well balanced. The financial sector is exactly what it sounds like, companies that offer financial services to people and to businesses. These services usually fall under the category of banking, investment, lending, and/or insurance. Some of the most well-known companies in this sector include JP Morgan Chase, Bank of America, and Berkshire Hathaway. The financial sector is very cyclical, as it is quite literally dependent on how much free-flowing cash there is at any given point. If things are going well and there's more money available, these companies will have more money to manage and more people to work with and/or loan money to, with at least a reasonable expectation of getting that money back plus interest. If not, well, then they're in trouble. As an investment, financials tend to be one of the most volatile of all sectors. In fact, by some measures, it probably is the most volatile. Not only does it have the worst average and baseline 5-year rolling real returns, as well as the best and worst single-year return, but it also has the highest standard deviation of any of the sectors. On the bright side, it tends to rebound incredibly strongly from market bottoms, even posting the highest maximum rebound intensity of any sector. The information technology sector consists of companies that offer software and IT services, produce hardware and communications equipment, and develop semiconductors. Some of the most well-known companies in this sector include Apple, Microsoft, Intel, and IBM, of course, but also things like Visa. Perhaps the thing that separates companies in this sector from other sectors is that they create growth opportunities for themselves and almost everybody else. Think of how much more efficient and effective we've become at work thanks to things like Microsoft Office and other pieces of software. That increase in effectiveness and efficiency generally leads to larger profits for our companies, higher standards of living, and a stronger economy as a whole. Of course, it takes a lot of investment into R&D to create these products and services, and as such, the sector is generally considered cyclical, or at least sensitive. This is because when the economy's going great, we have more wiggle room to spend on efficiency improvements than we do during economic downturns when every company is just trying to survive. As an investment, they tend to be pretty volatile. This sector holds the 3rd highest start date sensitivity and the highest Ulcer Index figures, as well as the worst 5-year minimum real return and crash depth figures since 2000. However, it also holds the best stretch return, the best upside and overall capture ratios, and even the best average rebound intensity. So again, when times are good, or becoming good after a down spell, these investments tend to pay off fairly well. When they're not, this sector can really struggle relative to the others. The consumer discretionary sector is made up of companies that sell things to us that we want but don't necessarily need, hence the name. In terms of specific industries, think retail, accommodations, restaurants, and so on. Some of the most well-known companies in this sector include Amazon, McDonald's, and Starbucks. This sector is the last one to traditionally fall into the cyclical category. Since the items sold by these companies are generally not considered necessities, they're usually among the first things people cut from their budgets during tough times. As investments, the consumer discretionary sector actually posted the highest average 5-year real return of any sector since 2000, at roughly 9.8% per year. Its overall growth is a little bit lower, but still impressive, as a $10,000 investment into a consumer discretionary index fund in 2000 would have grown to nearly an inflation-adjusted $50,000 by 2021, for a real annualized return of roughly 8.3% per year, which is far and away the best mark of any sector during these years. The consumer staples sector is the other side of that coin, comprising of companies that sell essential goods and services. Industries include everything from food and beverages to household and personal products like toilet paper. Some of the most well-known companies in this sector include Walgreens, Costco, and Coca-Cola. As these companies sell mostly necessities, they're usually less affected by the strength of the overall economy. As such, they're generally lumped into the defensive category. As investments, they tend to be pretty consistent, holding a lower standard deviation than any other sector except for real estate since 2000. The returns are also fairly dependable, regardless of when you start investing, with one of the lowest start date sensitivity figures of any sector. In terms of growth, its typical return is around the middle of the pack. but its ceiling is not very high, coming in either second or third to last, depending on whether you're looking at the short or long-term max real returns. The energy sector mainly covers two industries, oil and gas, as well as the equipment and services related to them, such as drilling. Some of the most well-known companies in this sector are Chevron, ExxonMobil, and ConocoPhillips. The energy sector is generally considered sensitive, i.e. somewhere between cyclical and defensive, as the majority of its revenues are tied to the price of oil and gas, which can shift both based on supply and demand as well as political decisions. But at the same time, they generally have generous dividends and their returns are fairly dependable, even if they aren't always the most consistent year to year. As investments, they've struggled a bit since the turn of the century. Despite those reasonably dependable returns, its overall growth in the short and long term has been below average, although it does boast the second highest single-year real return of any sector at over 49%. A similar story could be told about its standard deviation, and it has trailed inflation in nearly half of the years of this sample, which is more than any other sector. The healthcare sector includes companies that create and distribute medical equipment, supplies, and tools, provide medical services, research new medical technologies, and sell drugs to patients. Some of the most well-known companies in this sector are Johnson & Johnson, Pfizer, and Moderna. The healthcare sector is considered defensive as the need for medicine does not really go down much during economic turbulence, and in some cases, as we've seen in this most recent downturn, it may very well go up. And as investments, they've experienced strong growth with fairly low volatility, ranking third among all sectors in both the average 5-year real returns and standard deviation since 2000. They also tend to hold up reasonably well on the tranquility side of things. While it is around middle of the pack in terms of how often it's trailed inflation in any given year, it does at least cap those down years to less than 10% better than any other sector outside of real estate. The same thing can be said about the Ulster Index. So, at least since 2000, the healthcare sector has been a solid investment for growth without too much anxiety. The communication services sector mainly covers two industries, telecommunications and media and entertainment. Some of the most well-known companies in this sector are Google, Facebook, Netflix, Comcast, Verizon, and Disney. The communication services sector falls under the sensitive category according to Morningstar. This makes sense given that some of the companies within the sector earn a bulk of their revenue through means that are unlikely to be abandoned during economic hard times. I mean, most of us won't be getting rid of our internet just because the economy is weakening, for instance. While other companies might see their revenues more significantly affected, such as movie producers who may not be able to sell quite as many tickets to their screenings or maintain quite as large of a subscriber base or subscriber growth as before. As investments, this sector has actually struggled to grow, posting worse 5-year average real returns than any other sector except for financials since 2002. It also tends to trail inflation more often than most other sectors, and unfortunately it doesn't manage to make up for this with any metrics that are much above average. Here's where this sector ranked in various metrics. You'll notice that there's nothing for start date sensitivity figures for this sector, and that's because my start date sensitivity figures use 10-year rolling and future periods to calculate the figures, and since we don't have data for 2022 in yet, we can't get the full 10 years on both sides of any start date. The utilities sector is pretty straightforward. It consists of companies that offer and maintain the utilities for people and companies. Some of the most well-known companies in this sector include Duke Energy, Exelon, and Dominion Energy. The sector is considered defensive as you need to keep the lights on and the heat running even during market recessions. As investments, utilities have produced strong growth figures with the highest 5-year real median returns since 2000, and the second highest average returns. It also has the highest Sortino ratio and the third highest Sharpe ratio of any sector during these years, suggesting that its risk-adjusted returns are strong. And finally, we have real estate. Some of the most well-known companies in this sector are Simon Property Group, American Tower, and Crown Castle International. Real estate is traditionally considered defensive because people always need a place to live and work. Still, some areas of this sector can get hit really hard when the economy weakens, such as the development portion of the sector. So depending on the makeup of the specific fund, it might be considered sensitive, or even cyclical. In fact, Morningstar actually considers this sector to be cyclical. Based on the index fund that I used to gather the metrics for real estate for today's video, it seems to have performed very much like you'd expect from a defensive sector. Its returns may not be the highest, especially at the high end of the spectrum where real estate placed dead last for both the short and long-term maximum growth, but it comes with lower volatility. In fact, the lowest of all sectors. A low Ulster Index, again, the lowest of all sectors, and it beats inflation more consistently than your more cyclical investments. Here's where this sector ranked in various metrics, and again, there are no available start date sensitivity figures given the 2002 start date. So as you can see, there is a fair bit of variance between market sector performance, which has led some investors to over or underweigh specific sectors in their portfolio in order to give themselves the best chance of reaching their investment goals. In terms of pure growth in a vacuum, At least based on this data set since 2000, the consumer discretionary sector stood out the most. For consistency, the overall winner was probably real estate. Despite what happened during the housing crisis, it still did have the lowest levels of volatility overall. For dependability, it was materials, which was a bit surprising given that it was one of the more volatile sectors in the short term. Real estate also stood out in terms of overall tranquility, though consumer staples and healthcare also did fairly well. And finally, in terms of resiliency, consumer discretionary really stood out for its ability to bounce back quickly and sustainably from downturns. Real estate also stood out in the sense that the sector as a whole rarely fell enough to even be considered in correction or crash territory. So those are the 11 stock market sectors, as well as some strengths and weaknesses of each. Were you surprised by any of the results? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.